Good afternoon, everyone. Michael Buscema, I'm practice lead here at Aptum, and with me I have Stephen Michell, who is director at PCI Partners, who has over 30 years of experience in insolvency practice. Thank you for joining us here today. We are going to be talking today about the DPN Playbook, advice for directors and advisors navigating ATO director penalty notices. Now, Stephen and I spoke last year about director penalty notices, and it was quite the popular session. There were lots of questions. And the interest in director penalty notices, I don't think, has paused or slowed down in that time. So we thought that today we would do a follow-up session, a bit of a follow-up session around the practical implications of director penalty notices. And we'll cover a bit of the context of why director penalty notices are sent to understand some of the triggers. But we'll also focus in on what to do if someone's got a director penalty notice and those 21 days have passed, because we've seen quite a number of director penalty notices expire now. And what do your options look like at that point as opposed to when you first get a director penalty notice? We're also probably going to cover off on those surprise DPNs, which we've
Should be great.
Quite a few times now out there, and provide our own perspectives on what the future outlook regarding director penalty notices look like as well. And if those want to stick around to the end, there's a bit of a giveaway at the end of this session as well. So I thought I'd just start off before I throw some questions to Steve, just contextualising why we have director penalties to understand why people get them. So back in the day, before the director penalty regime existed, the ATO actually had priority in an insolvency for unpaid tax debts. Now, that priority was removed, and almost in exchange for that, the Commissioner of Taxation was given the director penalty power. So the purpose of the director penalty regime needs to be considered alongside of that context. It is there to cause directors to get their companies to confront the solvency of their business early, and to then explore insolvency options at the earliest possible point to ensure that those debts don't escalate and disadvantage either the Commissioner and revenue or other creditors as well. That's important to then think about what triggers a director penalty notice, because a lot of the time directors don't actually know that they might be on the hook for a director penalty until they've received it. But if you understand the why it's there, you might start to understand that if your company is in a position where it's starting to accumulate debt, particularly for those types of debt, we're talking about pay-as-you-go withholding, we're talking about GST, and importantly, we're talking about superannuation guarantee charge, you know that as soon as the company starts to incur those debts, you can probably now expect to receive a director penalty notice. And one of the important things to consider, which I think a lot of people don't understand, especially when it comes to surprise director penalty notices, is that the way the law works, directors are already liable to a penalty basically as soon as the company doesn't meet the due date for the payment of those unpaid amounts. And directors don't know about that until the ATO sends them a director penalty notice, but they've been on the hook that whole time, which is why you then see later on down the track being surprised once you get a director penalty notice. Now, even though the purpose of the director penalty provisions was to cause a company to confront solvency, there is also a punitive element of director penalty notices, and that's regarding the lockdown DPNs. And that comes about in situations where there is an extra element basically to penalise those who don't cause their companies to meet their lodgement obligations, and you no longer have that ability to use an insolvency option to put the company under. So I did have some questions for you, Steve, regarding, well, what does this practically mean? So where a company has a tax debt and a director approaches you, what is sort of the prevalence of directors having director penalty notices? And more importantly, are they aware of the risks of receiving one?
Good question. Thank you for upfront for inviting us to talk today. It'd be fair to say that at the moment, we're getting a lot of work driven to us because of the amount of director penalty notices that have been issued. And it'd be fair to say that some directors are aware of it, and they're normally the ones that act fairly quickly, but there are a lot of directors out there who have absolutely no idea what it actually all means. And when you look at the notices, and normally what would happen is we'll get a call generally from the company's accountant, and they'll say, look, the director has received this notice. Sometimes they're expired, sometimes they haven't, and the director would like to come and have a discussion with you about what they can do.
If directors were aware that they might receive a director penalty notice, so if they were aware that they're already on a hook for a director penalty, it's just a matter of the ATO sending the notice. If they approach you before they received a DPN, do you think it would assist them?
Oh, absolutely. I think that one of the real problems that and conceptually from an insolvency practitioner point of view, most directors who have, in particularly in that SME space, a lot of them don't act very quickly at all, and they'll continue to trade the business on without really seeking a lot of help. And eventually what ends up happening is they start getting these notices, they'll start getting a lot of pressure. They will go to their accountant and they'll say, look, what should we do about it? And then all of a sudden the accountant will say, look, I think it's time that you really seek some professional help from an insolvency practitioner who will at least be able to give you your options and maybe give you some way forward in terms of actually dealing with the issues that they've actually got. So to answer your question, yes, the earlier that a director can get on to seeking at least some advice in relation to the issues that they've got, probably the less chance that they will have of getting a penalty notice. And the key here is, and whether it's a tax office or other creditors, but the key generally is communication. The more that they communicate, probably the less chance of actually getting one, but it's not always the case.
Yeah. And on that point too, and I'm sure you see this a lot, there might have been instances in the past where advisors would tell their clients that, well, if you don't want to have to pay a debt, maybe don't lodge. We've heard this before. Unfortunately, we know that most people don't do that, but we do both hear stories from clients where they've been told that. The failure to lodge is I think the critical issue in terms of undermining the options you have, because that is when the penalties become locked down and some of the options you just discussed aren't then available. And I think it's useful for also advisors to know that if you've given someone that advice and your clients relied on it, then that can be potential exposure.
Well, I think that failure to lodge, the failure to communicate, that it's all part of the same sort of thing, and that's really directors not perhaps necessarily owning up to the issue that they've currently got. There is that perception that if they don't lodge, the tax office, for example, won't know what the debt is, then they won't go and chase it. The problem is that if it all goes pear-shaped somewhere down the track, it may come back to bite them, particularly in relation to the lockdown director penalty notice, and they're pretty deadly, those notices.
From what you're seeing, because that often comes up in a superannuation context as well, and as an insolvency practitioner, I imagine there's a question that you need to answer as to whether or not you're in a position where you can lodge if there's outstanding super. But are you seeing the ATO being on top of not just the recovery through a director penalty, but also auditing the super where there's a liquidation on foot?
Yes and no.
Okay.
Depends on really the size of it.
Yep.
In many respects. But there's certainly occasions, and I've got a number of liquidations at the moment that we're working our way through, where, in fact, I've got one where the tax office actually wants to come and have a look at the records at the moment. Now, I assume that even though the company's in liquidation, they want to know what the total debt actually is, and there's a lot of outstanding lodgements in that particular liquidation.
And the reason I ask that question is because if they do then raise SGC amended assessments, which they can while the company's still in liquidation, because those lodgement dates would presumably be missed, then directors can receive a director penalty notice for those amounts either during or after the liquidation, even following the company deregistration as well.
Well, I think that's right, and that's probably why it's important that lodgements are done on time. So even though a company might not necessarily be in a position to actually pay the debt, it really is important that the lodgements are done on time, because then that gets rid of that element of the issuing of a lockdown director penalty notice, maybe subsequent to a formal insolvency.
Yeah. Now, we spoke just before about what options might be available to directors once they've received a director penalty notice, and I think a lot has been said around what to do if you get a director penalty notice, particularly within those 21 days. And I don't propose to go over that in a lot of detail. A lot of people have spoken about that, but I will just reiterate the point that that 21 days actually starts from when the Commissioner puts that letter in the post, not when you receive it. So sometimes you have 2 weeks, even if you're aware that you got it. Just to stress the importance of speaking to someone like Steve, insolvency practitioner, around what your options look like, because if you file a defence, for example, or you go into a payment arrangement, neither of those options actually pause or stop the 21-day compliance period. So if you fail in your defence or your payment arrangement falls down and the 21 days elapses, you can't remit the penalty by putting it under. I'm not sure if you're seeing some of that from your end.
So I think, we get, again, clients will come to us, and one of the comments that is made is, can we just enter into a payment arrangement because that will get rid of the penalty notice? And simply the answer to that is no. You can enter into a payment arrangement, but if that time period expires and you haven't done something about it, then you're on the hook personally. So if your payment arrangement fails, a company subsequently goes under and doesn't pay that debt, the director's personally liable, and it's a parallel debt. The other important thing to note is that the address that it goes to the director's address on their ASIC register. So it's important that, and we've had a number of instances where director hasn't been aware that they've received a director penalty notice because they've changed address. So again, that's another important issue that needs to be addressed by directors when they move houses and residences, that address with ASIC is actually up to date.
Yeah, because that's a deemed service provision, so as long as it gets sent there, you can't argue that you didn't get it. Although something I found out recently, actually, there was a minor amendment to the law where instead of saying the ASIC records, it says the records of the register, which could arguably be your director ID records as well. So I think the takeaway is make sure that your address details with ASIC and your director ID records are up to date.
Yeah.
Now, if you've missed the 21 days, and we know the ATO sent tens of thousands of director penalty notices, a lot of people are outside that 21-day window. What are your options? So what I advise clients who fall into this position is to first ask yourself 3 questions. The first question is, do you disagree with how the ATO has calculated what it says you owe under the director penalty notice? Now, if it does, you might want to consider your options to cause the company, because the individual can't, to challenge those amounts. But typically director penalty notices come up because the company has self-assessed amounts. So there's often not a whole heap of room to challenge those amounts. But if there's some ordered amounts or there's some estimates, there might be an option. The second part is if you think you have an argument around not having to pay, so that it's reasonable that you shouldn't pay. In those situations, you might want to typically consider some of the statutory defences that might apply, which are really focused in on whether or not you took part in the management of the company or not due to illness or other good reason, or whether you took all reasonable steps to cause the company to meet their obligations. But I must say that those defences, the threshold is very high. The final thing to consider, while it doesn't really help you as against the ATO, you still have to pay, but there might be options to indemnify yourself against either the company or the co-director. But because some of those options are quite difficult to demonstrate, we often are left in a situation, at least from my end, Steve, where clients are just faced with the prospect of having to pay it or what their other options are. So I thought we'd throw it to you because it's not something that a lot of people like to talk about when they consider personal insolvency. So in terms of personal insolvency and some of the alternatives to bankruptcy, are you seeing more directors approach you regarding personal insolvency options?
Yeah, so what we are seeing at the moment is a lot of expired director penalty notices. So to go back to your original question earlier on, that the directors are just not aware of what they actually are, okay? And sometimes the only time that they become aware of it is when the accountant will ring them up and they may have gone to their the director's personal ATO portal and looked at their running balance, and they'll see the director penalty notice amount actually sitting there, and then they'll ring the director up and say, hey, did you receive something from the tax office? If you have, you better send it through to us. A lot of the time, a lot of the people that we're speaking to at the moment, particularly in small business, that have received penalty notice that they've expired. So what are the options? Well, we will talk to them about the various options and what each of them actually means. So one of the options is to pay the debt, try and get into a payment arrangement, because ultimately what the tax office could do is they could bankrupt the director if it's not paid ultimately. But we're not seeing that ourselves at the moment. We do a lot of bankruptcy work. We're not seeing the tax office take that step, but the natural progression from, we are seeing a lot of tax office related corporate insolvency work coming through, but not the personal side. But the natural progression is that eventually we'll see the personal side come back as well. You can go bankrupt. That is one way of dealing with it, and there's a number of ramifications which I'm sure we'll get to down the track about what bankruptcy actually means. You could do what they call a Part 10 arrangement. So that's really a very formal way of doing a proposal to your creditors, and if the creditors accept that proposal, it's generally it's a cents in the dollar payment it could be over a period of time, it could be a lump sum. But again, that's a way of potentially dealing with these issues. But really, they're the way. What you can't do though, and what I don't think would be very successful is where you say, okay, well, I've only got X amount of money, I'm just going to offer that to them, and you either take it or leave it, because I suspect that the answer is that they'll leave it and they'll say, well, we want the full amount that's claimed under the director penalty notice.
Yeah, and that's the big thing most people need to appreciate. It's that if all you can afford is an amount less than the debt, the ATO is not your general commercial creditor. They will view every decision around, well, what is fair for those who pay? And is it fair for you to pay less because you can't afford to it when other people pay in full? And they also just don't have the statutory power to do commercial deals as well. We get a lot of questions in our practice where we say to someone, well, we can't immediately see a pathway to challenge the director penalty notice, and you might want to consider personal insolvency options. And the question is, well, if I go bankrupt, what does that mean for my business?
Yeah.
How do you approach those sort of situations, and how do you go about explaining some of the advantages and disadvantages around personal insolvency?
Yeah, well, good question. Bankruptcy is one of those areas that it's quite complex. So generally speaking, a person is bankrupt for 3 years, and after 3 years they're automatically discharged generally from bankruptcy. It has a number of ramifications in relation to what the director can do. So you can't be a director or manage a corporation. You can still be a sole trader. There are some people that will come to us and they'll say, okay, well, look, I can't afford to pay this debt. It's all just getting way too much for me. And generally, these are people that are under a lot of stress. There are a lot of stress from people chasing them for money. They're under a lot of stress probably domestically as well. It's a very stressful situation, and you see a lot of marriages break up because of the financial stress that causes a lot of arguments within the family unit. So you can't be a director of a company. If you're a shareholder in a company and you go bankrupt, those shares will vest in the trustees. In other words, the trustee will be able to try and realise those shares, and the trustee's role is to realise divisible property and to distribute it amongst the creditors. And so really, in terms of a company, the company, there might need to be a new director appointed because, as I said, a bankrupt can't be a director, can't manage a corporation. There might need to be a sale of the bankrupt shareholding, maybe to other shareholders within the business. And then there are other ramifications like, if they earn over a certain amount of income, they've got to pay income contributions. You've got to ask for permission to travel overseas, but that's generally not too hard to get. And there's also ramifications in relation to the amount of credit that you can incur. So those sorts of things need to come into consideration when someone considers whether they're going to go bankrupt or not. If there's a family home and the bankrupt is an owner or part owner of that property, the trustee will realise that interest. Now, that might be through a sale back to the other owner of the property, or it might be a sale onto the market itself. So there is a number of ramifications that bankruptcy produces, and you need to be aware of all those and make an informed decision prior to going bankrupt.
Yeah. It's an interesting point because sometimes I get asked, well, thank you for explaining that. Personal bankruptcy doesn't sound like something I want to do just now. What if I just ignore the director penalty notice? So at a general level, it's probably not great to ignore a director penalty notice, but practically speaking, there's a couple of points to be made. Firstly, interest doesn't accrue on director penalty debts. So it will stay there, and there's no statutory time limit on debts. So it will stay there forever if you don't pay it, but interest won't accrue. So that is something. However, if you get any refunds that you're entitled to, then you will probably lose those because the ATO will take them to offset your director penalty debt. The ATO could at any stage initiate recovery action if you're not in a payment plan. Yep. And they could also send a garnishee notice, so compel third parties who owe or hold money for you to pay that to the ATO instead of to yourself. But I think a big one is one that sort of you touched on, is whether they're in business or not, the ability to get credit. If you've got an ABN, whether that might impact your actual credit score as well, then that can be quite an obstacle that you might need to confront regardless of whether you do the do nothing option or go down a personal insolvency option.
Yeah, I think though all those considerations need to be taken into account. It may very well be that if you don't do anything about it and you try and go and get finance from a financier, they'll generally go and do a search, a credit search, and they may very well see the tax debt actually sitting there. It may very well come up. They'll probably, at the very least, say, look, we'd like a copy of your ATO running balance account, the personal one, and then they'll see the debt that's actually sitting there. And one of the questions that a financier will probably ask is, well, what are you doing in relation to that? One of the other points that I'd touch on, though, which is very relevant, and I've seen this before, where someone will come to us and financially, they're in a lot of pain. They're in a lot of they've got a lot of problems. They leave it. They'll leave from talking to us, and then they come back 12, 18, 2 years later, and nothing's changed. They've still got, the problems are probably bigger, the debts are probably larger, and they really don't have very many options at that stage. And then they say, okay, well, I think it's time to go bankrupt. The thing I'd say in relation to that is, remember that bankruptcy is generally a 3-year process. In 3 years, you get an automatic discharge from bankruptcy. If they come back and leave it for 12 months or 2 years, they could have been 12 months or 2 years into the bankruptcy process, and 12 months or 2 years out of that bankruptcy process quicker. And it's something that they need to consider. So if their business is not viable, and sometimes that's one of the questions which we ask, particularly those that are running a business: is the business actually viable? And there's a lot of times that we see businesses that aren't viable, and therefore a formal insolvency is probably the appropriate solution to those problems.
That leads me to another question I was going to ask, because like you said earlier, the ATO is doing a lot of corporate insolvency work,
yes,
or at least tracking back up to they were before COVID, still not doing a whole heap in the personal insolvency space.
Correct.
So from my end, we see a lot of clients who start to consider their personal solvency where there's a director penalty notice and the company with the underlying debt is subject to winding up proceedings. But at the end of the day, directors and owners of businesses have a single pot of money, and it's a decision for them as to whether they direct that to the company to keep that afloat, to their personal debt. But once a wind-up proceeding's on foot, the time limit started. You're within a court proceeding. You've only got a handful of months to be able to deal with it. From a practical perspective, some of the considerations you said around exploring bankruptcy and going through all that, is that a lengthy process, or would that cause issues if you only confront your personal insolvency at the point of your company being subject to a liquidation?
It's a really good question. Generally what happens in practice is a director will come to us, and normally the company's got the problem. So for example, if there is a winding up on foot, there's a couple of ways that you can deal with it without the company being potentially wound up then and there by going through the court hearing date. One of the ways of dealing with it could be to appoint a small business restructuring practitioner, but there's eligibility criteria that needs to be met in relation to that, or a voluntary administration. They're the two ways that you can deal with it. If you don't deal with it in those two ways, then the company is likely to be wound up. You may very well be able to appoint a small business restructuring practitioner or voluntary administrator, and then they'll have to go to court and convince the court as to why it's in the best interest of creditors to not have the company wound up then and there. Sometimes you don't actually have that on foot, but still the problem is you've got this finite amount of money, and where is it actually better spent? And again, I think the question then comes down to how viable is the person's business. So sometimes if you've got a viable business, but it's just got a large tax debt and it can't jump over the top of that tax debt, it's just insurmountable, then and they might have got a director penalty notice as part of that process. Then one of the things that you could consider, for example, is doing a small business restructure or a voluntary administrator where you're putting a proposal to creditors to compromise the company's debt, and if accepted, then the company is in a much stronger financial position. When the company is in a much stronger financial position, then perhaps you're able to draw monies out of the company because it's profitable, it's generating good money, and those monies that can then perhaps go towards maybe a payment arrangement to the tax office to satisfy the primary, the personal tax debt under the DPN. Because bearing in mind that with a director penalty notice, the debts are parallel debts, and that's the important thing. So tax office can't double dip. If the company pays the tax debt, then it can't be, and there's a director penalty notice, then that director penalty notice, the amount goes down, and vice versa. So I think they're important considerations as well.
They definitely are. And another thing I found as well when there's both at the same time is that sometimes the company debt is much higher than the director penalty debt. And if you're in a position where the director, again, you got one pot of money and the director tries to do the right thing and pays their director penalty notice first, but there's a liquidation on the company,
Yep.
then that would proportionally reduce the company debt. But then there's only a finite amount of money in the company, and the director can actually be more out of pocket if they're not having a planned approach to both the liquidation and then the personal solvency side as well.
Yeah, that's right. Spot on.
Now, a topic that we get asked about frequently is the surprise DPN. Now, I was having to think about this before today to come up with what all the surprise DPNs are. And I think that there's two. I'm interested in your thoughts. But
Sure.
The second one's the bigger surprise. But the first one is typically the ATO has sent a director penalty notice later on down the path. It's been a firmer action that they take. It's for a bigger amount. It's for historic periods. And then they'd send it, but they wouldn't take you to court straight away. So you would know you have a director penalty notice. Like you said earlier, it might take some time before you do anything about it, 1-2 years. And then you confront it and you think, all right, well, I'm now in a position where I can either pay part of it or I'll consider the solvency of the company or myself personally. But there is the prospect of a surprise DPN around the potential additional director penalty notices for periods that arose after you first got that. And I think people don't realise that sometimes. Just because the company's being wound up or just because they've already got a director penalty notice, again, you're liable before you get the actual notice for the penalty. So it's always useful to speak to either an accountant or an insolvency practitioner around what your potential exposure might be. The other surprise is what we've already flagged on, is that, or already touched on, sorry, and that's the one where a company's already gone through an insolvency event. So that could be a small business restructure or a DOCA, or it's been liquidated and even subsequently deregistered. And once that process is finalised, the director thinks that the company debt has been dealt with, they might have contributed money in the insolvency process, bam, the ATO comes and issues them with a DPN. And the reason for that is that the director penalty notice is imposed by the law, not by the ATO. And if you miss those lodgement deadlines and the amounts are locked down, Just because the company goes through that insolvency process, that doesn't remit the penalty. The only way to remit it is by payment, irrespective of how long after that comes through. We had some questions come in advance of this and sort of gets to that point. So I think they're the two surprise. I'm not sure if you've seen some other surprise ones. But
look, I'll comment about both of those actually. It's not. I've seen quite a few people have come to us for advice, and who have received multiple director penalty notices, and you know for very one for a smaller amount, one for a much larger amount. I've heard of situations where the director might have tried to get a payment arrangement, and as part of that process of negotiating with the ATO, all of a sudden, the next confirmation they get is actually a director penalty notice attaching to it as well, even prior to making the payment arrangement, even though they're in discussions with the ATO around that. So I think they're real surprised, and I was surprised when there was someone that came to me recently and said that was actually the case, and that she had been negotiating with the ATO, and during those negotiation processes, that she issued a director penalty notice as part of it. So, which I found was interesting. The other thing is that, and I hadn't seen many of these, certainly not pre-pandemic, but these director penalty notices, these lockdown director penalty notices that get issued after the company's done maybe a voluntary administration with a deed of company arrangement. I haven't seen them with small business restructures, but I have seen them with liquidations. And that is where, after the company's gone into, let's say, a liquidation, then the director has been issued with a lockdown director penalty notice. Now, we do a lot of liquidation work, and I haven't seen too many of them, but certainly in the last probably 3 months I've seen two that are certainly in that category. Before that, I only knew of one, and that was many years ago, and that generally was for a very large amount and a lot of super that was actually outstanding. So maybe that's not knowing the actual internal workings, and maybe you can comment on this, Michael, but super is certainly one of those areas that the ATO gets very upset about in terms of the outstanding amount. But that seems to be, and anecdotally I've heard in the industry from some of my colleagues that this is it's not common, but it's not uncommon as well to get these surprise director penalty notices.
Yeah, and it's definitely happening in a superannuation context. So when we talk about triggers for director penalty notices, I mean, we know about the collectible debt book problem that the ATO has. We know that is driven primarily through unpaid business tax, so pay-as-you-go withholding and GST, which you can get a director penalty notice for. And relative to sort of how much super is payable, there is a fairly large proportion, it's generally over $2 billion of unpaid superannuation guarantee charge. So the ATO's position is that, well, the employees never got paid. It might seem unfair that you thought it was dealt with, but the law makes you liable. Just, it's a debt. We're responsible to collect it. We're going to send you a DPN. I'm not making a call as to whether or not that's fair or not. I might have my own personal views, but that's what we've seen in practice the ATO view to be, and that will focus in on unpaid SGC even after the insolvency event, but not exclusively. I haven't seen it as much, but I have seen some for pay-as-you-go withholding and GST. And if they're going to look at the super after the event, then they'll probably look at the other taxes as well. They're not just going to focus on super.
True.
Are there any steps in your mind that a director can take either before they approach you to put the company into an insolvency process or during to mitigate the chances of receiving a surprise DPN?
Probably the most important one, I think, and again, it's something that we made comment on earlier on, and the most important thing is the lodgement being done on time. That's the critical thing. And look, there's been times where you do hear for example, accountants saying, well, look, and directors, look, if we don't lodge, they won't know. But they can base these director penalty notices on estimates and all sorts of things. And, you know, with the introduction of single touch payroll and soon the super payday super, you know, there's probably not going to be too many places to really hide, if that's a term that you can use. That is the critical thing, because, you know, if everything's lodged on time, and even if it's not paid, you know, you can communicate with the ATO, but even if it's not paid, and the company does then go into liquidation, you're not going to get one of these lockdown director penalty notices, because they are only based on late lodgements. So that is the critical thing. In terms of how else you can deal with it, well, you know, at the end of the day, it comes back to, you know, what is the, what are the resources that are available to the director? What's the company's viability? And it may very well be that the company can survive, so it's important that the company survives, because that then allows maybe the director to go and negotiate a payment plan with the ATO to deal with the expired director penalty notice.
That's a helpful tip.
Yep.
Now, you just touched on payday super.
Yeah.
Now, we also get asked a lot of questions. Well, the ATO sends a lot of DPNs. What's happening next? What's the future outlook look like? And before I get onto that, just on the number of DPNs, we get asked this question a lot. Is it 26,000? Is it 40,000? I'll just clarify. Both numbers are actually correct, but for different reasons. So 26,000 DPNs is round about the number when you consider how many company debts there were out there. 40,000 is the figure when you consider the number of directors who then received it, noting that some companies can have multiple directors. So both those numbers are right, but for different reasons. But they're high numbers. They're much higher than they were before COVID. Some people ask, well, is the ATO automating DPNs? Well, no, they're not automating the decision to issue a DPN. A human still does that, but one of the benefits of automation is that processes become more efficient. And when you couple that with a focus on collecting unpaid debt, we're seeing a lot more of them. And the debt book, while I think the growth has slowed down and it's fairly stable, it is still very high. So we can imagine there's still going to be a lot of debt collection activity occurring over the foreseeable future. But I think we will see the type of collection action change over time. So historically, the ATO had sent director penalty notices later on in a process. They would send some letters or some SMS nudges, and then they'd try to call you, they'd try to negotiate. And once that broke down, then at that stage, they might consider a director penalty notice. However, I think what they saw over COVID was that if you don't have the ATO intervening early, then people, not all people, but some people will take a backseat and not prioritise their tax debts, which will see their tax debt accumulate, such that if you then send someone a director penalty notice when the debt is large, there's actually not a whole heap the director can do to cause that debt to be paid. They might then make a decision around insolvency if it's not locked down, but the money's no longer there. So what they're thinking is, well, if we start to issue director penalty notices sooner, while the debts are small and before the money has potentially left the business, people might actually be able to confront their debts before they become unmanageable, before their businesses need to go under, which I think conceptually makes some sense. The other part of that issue on the converse, though, is that if you have a situation where you get a director penalty notice when your debt is small and you have 21 days to decide whether you pay it or you put the company under or appoint a restructuring practitioner or an administrator, you might think, well, I'm not going to go through an insolvency process for 1 quarter of unpaid debt. So you don't do anything within the 21 days, you think you'll pay it. And then you fall behind the next quarter and the ATO issues you another director penalty notice and you do the same thing. Now you might get 4 or 5 quarters in and you might think, all right, now I've realised I can't actually cause the company to meet these obligations. I'm going to put the company under. But by reason of the ATO sending more timely director penalty notices, you're going to see that those options to use insolvency options would be expired and you're not going to be able to get off the personal liability for those. And I think that's going to be the space that we're going to have to navigate in future, where you get more timely director penalty notices and directors are going to have to confront solvency questions in a different way. They're not going to be as often be given a DPN with for a huge amount, and it goes without saying that the company's stuffed, but they're going to have to make more timely decisions. Is that what you're seeing?
I think so. I think what, and again, this is only my opinion, but the tax office is just trying to change behaviour, and
Definitely true.
and I think that if you look, during the pandemic, there really wasn't a huge amount of collection activity that was done during that period of time, and a lot of small business owners, they were struggling as well. You got to remember that a lot of businesses came out of the pandemic, and it wasn't a great time for a lot of businesses, and they were paying those suppliers or those creditors that were screaming and jumping up and down, and to keep the lights on and to keep the business operating. The tax office has then come back in and it has given, it's been a process, and you can see the process that they've gone through. And, the process really was, well, let's issue some warning letters, get the lodgements up to date. Let's issue warning letters in relation to director penalty notices. Let's issue director penalty notices. And so you can see that process has taken, a period of time to go through, and now it's just issuing penalty notices. Now, I think what you're saying is right. It's to try and change behaviour of the taxpayer, trying to make sure that what they're looking at is, okay, well, look, I've got a tax debt that's sitting here, and it might be, maybe 2 or 3 quarters eventually, that might be the trigger to getting a director penalty notice issued. Really, at that point of time, what they're trying to say to the director is, hey, look, you owe this tax amount. You need to consider what you're going to actually do. How is the company that you're a director of going to meet its obligation? And at that point, the trusted advisor is generally the company's accountant. And going to the company's accountant and actually talking it through, the company's accountant might say, look, I really think this is a matter where you need to get some further advice from an insolvency practitioner about what your options are, what you can do about it. And I think maybe that's where we end up. I'm just not sure how long that's going to take, because there is still a significant amount of tax debt, as I understand it, out there for the tax office to collect.
That's true.
It may take a number of years to filter through the system, but maybe that's where we end up.
And it's an interesting point, because I think that there are almost 2 categories of tax debtors at the moment. There are those who have a wad of historic debt that they can't clear, and then there's those that don't but are starting to get in trouble now. And I think the ATO's approach around timely director penalty notices is probably helpful, or more helpful at least, for those entering debt rather than having the historic debt. But there's going to be different decisions based on what position you're in, I imagine.
Well, that's right. And I think, the other thing to note is, you look at, for example, small business restructures, and when, and the ATO is one of the major players in that space in terms of being a creditor that's owed a lot of money. It's the communication. These are all fairly straightforward things, but the tax office is going to be more favourable, even if you've broken payment arrangements down the track, but you're at least communicating with the tax office. I think that the ATO have said quite publicly, we're going to chase those businesses at this stage, at least, that aren't communicating. They've got big tax debts. They're not communicating with us. They're the ones that we're going to go after. And I think that's probably what's happened.
Yeah, and I think the ATO has issued media releases saying that they're focusing on quite a small number of taxpayers who have quite a significant portion of the debt. And I think it's also important to consider, the ATO often talks about their debt problem as the scale of their collectible debt book. What is collectible debt? It actually means something quite specific with the ATO. Collectible debt book is debt owed that doesn't include debt that's under a formal dispute. It also doesn't include debt that they call insolvent debt, and they don't mean debt once a company has gone through an insolvency process. It includes debt of a company or an individual that's in an insolvency process. So simply appointing a restructuring practitioner or an administrator or a liquidator actually gets the debt off the ATO collectible debt book. Now, obviously, payment is the preference for the ATO. Obviously, they want to recover revenue, but like you said, there's a lot of debt out there. The ATO is not going to be able to recover all of it. So there is an opportunity within that while you're assessing your options, if you're concerned about what the ATO might do in future, of sort of navigating your own course by speaking to an insolvency practitioner, because there might be an option that the ATO can live with. Particularly if you put up a DOCA or an SBR, you might see the ATO as quite favourable because it actually helps get them off.
Yeah, that's right. I mean, the ATO, they're very supportive of small business restructures. Generally speaking, I'm not quite sure what the percentage number, but it was up around the 90% mark of acceptance. So they are, and that's certainly the experience that we've got. If it's a reasonable proposal, the taxpayer hasn't had large outstanding lodgements over a long period of time. Generally, they're quite receptive to that sort of thing. So, they're reasonable in terms of dealing with that side of things.
And if we've got a situation where the ATO is going to continue issuing lots of director penalty notices, they're going to potentially be for newer debts. We've got accountants who are going to have different conversations with their clients around what their options are. What do you see as the role of insolvency practitioners during this transition to a dynamic where there's just going to be more director penalty notices and solvency is a more critical question? And what are the points not only directors but sort of accountants and advisors should think about getting in touch with an insolvency practitioner?
Yeah, I think the insolvency practitioner's role is to put forward the various options that are available. So as the longer that a director leaves it before seeking professional help, the less options that are generally available. So as an insolvency practitioner, what we're looking at is, okay, what options are available and what does each of those options actually mean for the business and maybe for the director personally? So, there are a number of things that we would look at, and the vast majority of insolvency practitioners can look at a balance sheet, for example, and drill down on what the issues might actually be. So, for example, one of the issues might be that there's a debit loan account to related parties or the director. And in a liquidation, a liquidator has to go and collect the assets that the company actually has, and so they can be distributed out. And so there'll be a demand that will be issued in relation to collecting that particular loan account. That might mean, for example, that option's out. There might be, for example, insolvent trading, a consideration in relation to that. So liquidation might not be the best option for it. It might be that the company is eligible to do a small business restructure. That might be a good option because ultimately, if that doesn't go through, the company doesn't automatically go into liquidation afterwards. It might be a voluntary administration if it's a company that's a little bit larger or a little bit more complex. So that's what an insolvency practitioner is to look to the various options that are available and explain what each of them are and what the ramifications are, so the director can go away informed as to really what they should do. Now, it might not be a formal insolvency situation at all. It might be that they've got a really viable business and they just need somebody to help negotiate the process of maybe getting a payment arrangement with the ATO. So again, an insolvency practitioner will put that framework around the problem and try and find a solution to it. But again, the trusted advisor, who's the accountant, their role would be, when the director comes to them, to identify whether the business is viable and whether they need to seek some additional help from the insolvency practitioner.
Thank you for that, Steve. It's a problem that presents itself quite frequently,
It is.
I imagine, in both our practices. Now, we did get some questions in the lead up to today's event, and we've got some questions throughout. And I do encourage you, if you've got some questions, please send them through in the chat. I might go through a couple. I think we've dealt with a couple during the session, but in terms of some of the extra ones, we're asked, is there any mechanism to reverse a DPN once it's submitted by the ATO? So I think there's some internal debate within the ATO on this, but generally speaking, you can't withdraw a director penalty notice once it's issued. But I think the thing to go back to is that the law imposes the penalty. The notice just tells you about it. Now, practically, that means you'll see it on your account once you get the notice, but the notice isn't actually what causes the penalty to arise. Now, this is a good question. I might ask you first, and then I'll come in. But and I think you've already sort of answered part of it. But what's the best strategy, justification, process, and channel when negotiating with the ATO that increases the chances of a successful outcome? Firstly, I think the perfect answer to this question would be worth a lot of money at the moment, but there are little ways you can go about doing it.
Yeah, that's a good question, because there is really no hard and fast answer to this question. It depends on how complex it is. So if it's a relatively simple debt, again, comes down to communication, viability. If those things are all in play, and maybe that's the answer. It could be a payment arrangement with the ATO. Whether you get what you want, that's the other question. And the ATO will require. It used to be fairly easy. I think during the pandemic, you could just ring up and the automated service would give you a payment arrangement. Yeah. Those days, I think, are well and truly over. Now you need to provide a lot of information. It might be that if the problem is a little bit more complex, and this I think is where you come in, Michael, is that you might just need to get some legal advice. So for example, it might be that there's superannuation. So the tax office has issued a director penalty notice in relation to superannuation. Being super guarantee charge that it believes is actually outstanding. And yet the director might, for example, say, well, actually, we paid that to the super funds. And I've had a situation like that of recent times where the directors needed a lawyer to go to actually navigate their way through what that all means. Because the super had been paid in the most part, but the statements that you're meant to lodge, they'd been paid late. So the statements that had been lodged hadn't been lodged, and of course the director penalty notice had been issued. That's where you can need some good legal advice.
And we've seen that and helped multiple clients out with that. It's definitely an issue. It goes back to what I said earlier. If you're in a position where the ATO says you owe money, I think it's always important to ask yourself, one, do you agree with how they've calculated that amount? And if no, then it maybe is coming to either your accountant or a lawyer to go through what your options in that regard are. If you do agree with the amount, but you think there's another reason you shouldn't have to pay, then you can potentially get legal advice as to what your options are in that regard. It is sometimes hard with the ATO. The ATO does have a lot of formal power to be able to collect money, but there might be options. And then it's, yes, once you are in a position where you know you have to pay. The practical tip I would give is that I think a lot of people fall into the trap of either not giving enough relevant information or providing too much irrelevant information. And at the end of the day, the people considering these requests, they see many requests and they follow a process in considering these. And the best way to get someone to review your application is to present it to them in a way that follows their process as closely as possible to make it as easy for them to come to the decision that you're after. There's no certainty with the ATO, and there might be some inconsistency still in decisions that we're seeing. But the starting point, I believe, is always to look at the relevant practice statement, the PSLA, whether that's 2011-14 for payment arrangements, -12 for duke remissions, etc. Look at what the factors are, because those factors are replicated in the ATO's procedures. If you can outline your request in a way that mirrors that, it probably puts you in the best position to be able to get that. Got another question. If a director has taken all reasonable steps to complete lodgements for particular reasons is unable to do so, but for particular reasons is unable to do so, will the ATO waive the DPN? And have I had a case where the DPN has been waived? So you can't waive a DPN. If you've taken reasonable steps, it would be a defence to the director penalty claim, which means you don't have to pay it. The getting the lodgements up to date might be part of the story. I imagine you would struggle in a lot of cases because if you can't get the lodgements up to date, there might be other things that an objective person could do to get around that, to get the lodgements up to date, particularly if you know there's going to be unpaid superannuation in particular. That said, though, all defences are factual based. So you can always look at whether or not that prevented your ability to report your debt, know what it was, and then pay it. I would recommend in those situations to get some legal advice, because there are cases that go through that.
And I'd concur with that totally. I think that, if someone had come to me and given me those circumstances, you'd be the first person that would get the phone call, Michael, because I think that they really do need to get some legal advice in relation to that, and you can put a case forward on their behalf.
If a director goes bankrupt, I assume the company still remains liable for the ATO debt together with the bankruptcy. So what Steve mentioned before is accurate. The debts are parallel. So if there's a company with a debt and director or directors with a debt, they're all parallel. If one party, for example, the director goes bankrupt, the company still remains liable, as does any other co-director who's received the director penalty as well. Just likewise, if the company goes under, that's why directors can still be personally liable as well.
And I've seen situations, just briefly, where a director has maybe resigned as a director and been replaced by another director for a variety of reasons. That really doesn't sort the problem out.
Yes, and there are rules around that you should follow into that we probably don't have time to discuss, but I think the important thing to know is if you're a new director, you have some time at the start, it's 30 days to make the company comply with its obligations, but if you don't, then you can be on the hook for director penalties for periods before you're a director, which catches a lot of people out.
And the old director can still get a director penalty
And the
notice.
old director can still get a director penalty notice as well.
Yes.
No stone unturned. Probably time for one last question. If a company enters an insolvency process with an outstanding tax debt but has done its lodgements, does the company entering insolvency process automatically discharge the director's liability even where no DPN has been issued? Or does entering the insolvency process only discharge a non-lockdown liability once DPN has issued? So I might just quickly clarify. A penalty is either lockdown or it's not by reason of the timing of the lodgements. And there's different lodgement windows for the 3 different types of taxes. If the company has met its lodgement obligations relative to those periods, so they've lodged within 3 months for GST and pay-as-you-go withholding, or by the due date for the SGC, then the penalties aren't locked down. So provided the company goes into an insolvency process before the end of the 21 days after a notice is sent, then the penalty is automatically remitted. However, if those lodgement dates are missed, then by law those penalties are already locked down. So irrespective of when the company then goes into an insolvency process, then unfortunately the entering into a liquidation or otherwise does not remove that director penalty, no. All right, well, firstly, I would just like to say a big thank you for Steve to spending some time with me today. I know there's been a lot of DPN discussion, but I think that today was actually a useful one for directors and advisors to understand what some of those options look like, where they probably missed the first 21-day boat.
Yes.
And what they can do from there, because there's going to be a lot of personal debt out there now because of director penalty notices. And a lot of people don't like to talk about that, but there are things to consider. So I do appreciate your
There's
time.
certainly options there, and I appreciate the opportunity of coming and joining you today, Michael. Thank you.
Thank you again, Chris, for your time, and thank you for all attending. I hope you found it informative. Enjoy the rest of your day.